We are going to start today's session with a conversation with Ravi Mohan from Shasta Ventures. Welcome, Ravi, to the show. Is Ravi's video audio clear?
Yeah, can you hear me?
Yes, we can hear you fine, and we can see you fine as well. Great.
Excellent.
So, Ravi, let's start by introducing our audience to you and to Shasta. Tell us a bit about your background, as well as as we are sitting in 2018 June, what is Shasta's investment focus?
Sure, absolutely. So I'm very fortunate to be a venture capitalist. I began my career building software. I did that at 3 different companies. I started off working with a large systems integration company, Anderson Consulting, now called Accenture. And since I've been in the technology industry for quite a while, over 20 years, I began writing mainframe programs for them. I then moved to a software company that ended up becoming Hyperion, and I was a pre-sales consultant for them with a new business intelligence product. And then I worked 3 to 4 years in India with my mother when we had a small software business building decision support systems. Our customers were large multinationals domiciled in India, as well as large Indian businesses. We also did work in the Far East in Singapore, Indonesia, as well as had some customers in the U.S. After I finished that, I got my MBA, and through good fortune, I entered the bid for business in 1996. And for the last 22 years, I've been a venture capitalist focused on software companies, SaaS companies, infrastructure companies whose customers are other enterprises. Shasta is a classic early stage West Coast-oriented venture firm. We have raised 5 funds, and we're currently investing out of our 5th fund, which is a $320 million fund. We invest across stages. We do seed investments, Series A, Series B, Series C, and sometimes, occasionally, we will do a growth investment. Our areas that we focus on are business-to-business software and software as a service, business-to-consumer services, and what we call emerging platforms, and that includes augmented reality, virtual reality, robotics, space, and so those new platforms are what we categorize as emerging platforms. We have 7 investment partners and a small staff.
So let me double-click down on a few things that you talked about. First and foremost, you said West Coast-oriented, but you also prefaced the introduction with your very deep background in India. So how does that play in your investment activities today? Are you looking at companies that are Silicon Valley headquartered or West Coast headquartered, but have a lot of India backend and so forth, or is it pure West Coast companies?
In terms of geography, we invest primarily in the West Coast, where the headquarters of the companies are, and that includes Seattle, Los Angeles, San Diego, the Bay Area. We also have made a series of investments in Austin, Texas, and a series of investments in New York City. The reason we are not able to invest beyond these geographies is primarily that we're not there enough to be able to work closely enough with the entrepreneurs that we back. In terms of India and having a back end in India, many of the companies that we are invested in have engineering, product, customer success operations in India. And so it's not a requirement that they have the back end in India. They could have it anywhere. They could have the back end in Silicon Valley, as far as we're concerned. But it's mostly the go-to-market team has to be in the geographies that I mentioned, as well as the senior leadership.
Fair enough. And just to complete that configuration question, so because of our activities being entirely global, we see nowadays companies everywhere. We see companies all over the United States. We see companies in Europe. We see companies in India, of course. and so forth. And many of them have aspirations of coming to Silicon Valley and set up their go-to-market operation. Maybe they do validation elsewhere, but they come to, go beyond the validation phase to the next, Series A, Series B in Silicon Valley. Is that something you're seeing? I'm sure you're seeing India, but are you also seeing Silicon Valley go-to-market, but backends, whether it's engineering, customer support, QA, et cetera, in other parts of the United States, in Europe, et cetera?
Very much so. I do think that the business has now become the business of creating technology startups that disrupt the status quo is a global business. Some of those markets that the companies get started on are aimed at overseas markets, and they're very successful. You can look at Baidu, and you can look at Tencent going after the Chinese market, look at Flipkart in India. Those are all fantastic companies. But at the same time, they're in business to business. You see companies get started in a variety of different geographies and then look to tap into the U.S. market and grow. There have been a number of Israeli companies that have been successful, primarily in the security space. There have been a number of Australian companies that have been successful. Atlassian is a good example. Canva actually is marketing in the U.S. market, but has taken steps to go to market in Australia. You're starting to see some really interesting companies coming out of Europe. Algolia, for example, out of France, is a recent example in the search space. So we're seeing it more and more.
Yeah. And when you say seed stage or early stage, define that for us. What is your definition? Let's take B2B. What is your definition?
Seed stage, early stage could be as early or as an idea without a product. It could be as early as that. So we backed, or I'm on the board of a company called Lean Data, and I've known the entrepreneur for 20 years, and he and I discussed starting the company that he wanted to start, and then from that discussion over dinner, that led to him having an executive in residence position at Shasta, and that led him to recruit a co-founder, build a business plan, or have a rough idea as to what the product was going to look like, and that led to a $1 million investment from us. Now the company has 350 customers. It's on its way to doing $15 million of contracted annual recurring revenue this year, and has raised in total $18 million. So we've been involved in all stages of investing in the company to date.
And when you make that decision to invest in a concept stage company, which very few investors do really these days, is it a requirement that you've had a long-term relationship with the investor, with the entrepreneur?
Yeah, I don't think it's a requirement. I think that, for example, if we did not know Evan as well as we would have, but we were still impressed with him and we got to know him, and we liked the idea, we might work with him or her as an EIR and get to know each other better. And the primary reason around this is when you're investing at an early stage and an entrepreneur is working at an early stage, the key criteria for whether the enterprise is going to be successful is finding product market fit. Yeah. And finding that discovery is not is a process that might take many different turns. And there might be some positive turns and there might be some negative turns in that process. And so to actually navigate that road in a constructive manner, trust is incredibly important, and understanding each other is incredibly important. Clearly, that trust can be built over many years, but it can also be built in a shorter period of time, depending upon what both the entrepreneur and the venture capitalist is willing to invest in the relationship.
We focus a lot on that product market fit process. So our guidance to our entrepreneurs most of the time is to figure out that product market fit before going out to raise money, which is, the vast majority of the market is in that mode right now. So that's just an aside. So let's talk about in B2B, do you have sweet spots? Are there specific things that you are noticing or liking in what you're seeing? Let's say if you look at your last 18 months of deal flow, what kind of trends are you seeing, and what trends you think are going to be the genesis of major venture-funded companies?
Well, clearly, the areas that we are we're investigating, fall into, let's say, three broad categories within business to business. One, we're looking at security. The security is a very, very broad area. It impacts every enterprise's brand, every enterprise's ability to interact with their customers and their partners in a manner that is that respects that relationship from a confidentiality perspective. And the benefits of people finding ways around those security guards at scale is huge. So they might be doing it because they might be annoyed at a company and want to create a PR issue with the company. They might do it actually to make money. There's a lot of different reasons why people are, attacking large enterprises. And given the fact that the world is changing with cloud and mobile and new serverless technologies to build and run applications, the footprints of what needs to be done to secure the enterprise and live within the rules that are available, as well as live within them through compliance, as well as show that you've done what you've done properly and treated people with the appropriate level of respect, concern, and protect their information. There's a lot of opportunity in security, and one of my partners, Nitin Chopra, is focused in that area. Mm-hmm. Second, corporations are becoming more and more are moving to utilizing the data available for them to be a more data-driven organizations. And so there's a lot of opportunity in terms of understanding, pulling that data in one place, understanding that data, and converting that data into actionable intelligence that can drive decision-making and workflow to help companies achieve their business, adapt their businesses based upon data. So we spend a lot of time looking at both data infrastructure, data processing, smarts that are more, I would say, horizontal oriented. Mm-hmm. And lastly, in the application software world, we bifurcate that into two categories. We're looking for smart applications, applications that take information and help intelligently assist humans to drive better decision making and better workflow. We just made an investment in a company in Seattle called Suplari, started by an Indian entrepreneur, grown up in the U.S., that's going after the procurement space and really looking at how do I build a smart procurement application to help companies ensure that they buy stuff that they've contracted with at the price that they've contracted with within the budget that they've set up in the year. And they're using smarts to make sure that that happens. And then the second area within software as a service that we're looking at is replacement markets. There's a whole host of automation that's happened, both mainframe as well as client server, and there's a huge opportunity to, as these applications get older and new capabilities are required within them, to go after replacing them. Some examples, obviously, that are very successful that most people know about is Salesforce is a replacement software for CRM, and they replaced Siebel and has built, close to $100 billion market cap company around that replacement market opportunity. Workday is doing the same thing for human capital management and ServiceNow is doing the same thing for help desk. So, there are more categories out there, and we're looking in those areas.
Okay. And could you take us through a bit of the thinking for your portfolio strategy in B2C, both trends that you're seeing as well as where your bets are?
Yeah, obviously, well, not obviously, they're always, every new communications platform yields huge new B2C companies. So with the internet, you ended up with Facebook. Mobile hasn't quite gotten there yet with, well, I guess you did have WhatsApp, which was a great acquisition by Google, and you had Instagram, which was a great acquisition by Facebook. So, those are mobile, camera-oriented, in Instagram's case. So we do look there, but they're hard to understand which ones will actually take off and which ones don't. So we, although they're a very good area for entrepreneurs to build businesses, we tend to be more conservative around backing those types of businesses because we aren't sure which ones will win. Okay, so that's an area that entrepreneurs should look at, but it's not an area within Shasta that we spend a lot of time in. Within Shasta and consumer, we're looking at 3 areas, very defined. We're looking at subscription-based businesses that are offering a product and service that people can subscribe to. We've made multiple investments in this area. Some examples are healthy, ready, prepared dog food that's delivered, called the Farmer's Dog. And they make human-like food and package it, customize it for the type of dog, and get it delivered to the house, and that's a premium subscription service. We have a contraceptive service for women called the Pill Club, where they can go consult a doctor online and get birth control delivered to them on a subscription service. And the third one that we've made recently is a company over the last couple of years called Imperfect Produce, which takes excess produce from grocery stores that don't look the way the grocer wants to present the food and deliver it to people on a weekly basis. So let's just say a carrot that's not perfect, it's not perfectly pink or orange and has some blemishes on it, might be put into the Imperfect Produce basket that someone subscribes to. So we are looking at subscription companies that, that fulfill a real need, that have the ability to have a high margin, that have an ability to have a brand, and that create real value for their customer. So that's one category. The second category that we're looking at is financial services, the new types of financial services. We have invested historically in companies like, including Mint, which was kind of a web-based Quicken that helped you show you how much money you had to spend this month and manage your money better. We invested in an online banking company called Simple, which lets you set up a deposit account online and have mobile applications that help you do your basic banking in a better manner. And more recently, we've invested in a company called Tally, which lets you consolidate your credit card debt on your phone and bring down the cost that you might pay in terms of fees and interest. So we keep looking in that area for using technology to disrupt it, to disrupt the incumbents, and find valuable consumer services that people would want. So that's the second area. And the third area that we're looking at is personalized medicine through genetics with a consumer bent to it. So we have small investment in a company called Color Genomics, and we look at other types of genetically oriented or DNA-based ways to customize medicine that can be delivered to the individual. So those are the 3 areas that we do in consumer.
Okay. And you didn't really say non-subscription e-commerce. Is that a correct observation, that you're not doing non-subscription e-commerce?
We do some non-subscription e-commerce, but it's not a focus area. So we have made investments in Stance, which is a branded company making socks and now getting into other categories. We've made an investment in a company called Poppin, a very large investment, which makes office furniture and office goods that actually are design friendly. So think of them as, I don't want to get IKEA, but I don't want to spend $50,000 for a desk. And I'm going to get something that looks nice, that fits my brand, that enables me to create a vibrant office without having to spend tens of thousands of dollars for each piece of furniture. There is, as it turns out, Poppin, although it doesn't have a subscription, an official subscription component, when they land accounts and they equip an office, it usually leads to a lot of follow-on orders from the same customer as they might equip other offices or expand their use of their products within an office. The primary reason we like subscription businesses is the ability to create a long-term customer relationship, and the cost of actually acquiring any new customer is very expensive. And the key is, can you offer a good or service that the customer in a relationship that once you've acquired them, you deliver on it, and they keep buying more things through you. And by doing that, one in general is able to create more profitable businesses. Now, that does not need to be exclusively done through subscriptions, but it's easier to do it with a subscription.
Yeah. Well, one of my observations, and I was talking with somebody who operates in the Indian ecosystem with B2C e-commerce, is if you're doing a pure logistics play, even in niche e-commerce, I think it's getting harder and harder because Amazon is so comprehensive. The big categories are all taken. So the way to differentiate is with new products, branded products. And I think what you are layering onto that is the notion of repeat purchase and or subscription. So I think, for those of you in the audience who are listening to this conversation and you're thinking about e-commerce businesses, pay attention to these nuances because the baseline of e-commerce businesses is becoming tough. If you were talking about venture scale businesses, you can still do niche e-commerce businesses in smaller categories. If you can carve out a very small niche and create a $5 million, $10 million business. But if you're talking about building a $100 million, $200 million, $1 billion business, that opportunity, that set of opportunities that will lead to those kinds of businesses are fewer and far between unless you can differentiate with a product, a differentiated product or product line. Would you agree with that, Ravi?
Yeah, very much so. I do think that, I think that one can look at different types of businesses. So you can look at something like Casper, okay, which is going after the mattress business and say, okay, here's a category that's large, that's not a subscription, but the user experience is so terrible with the incumbents, I can disrupt it. And maybe I can actually develop a better user experience, and I can do it at a better price because I'm going to optimize the supply chain in a way, and it's a big enough category that I can go and disrupt it. And so that can happen. Now, the next question is, how far can you go in that category before Amazon gets in? That's also another question. Maybe there might be some nuances in particular supply chains that lets you execute in that supply chain in a way that Amazon might not want to. Maybe the market size, the market for mattresses might not be big enough to deal with the complexity of the supply chain for mattress manufacturing. Might not
the mattress market actually has exploded. We have had several mattress case studies. Satva, which is a bootstrap company that has gone up to over $100 million, Purple, and so forth. So it's, yes, Casper found the opportunity and some others found the opportunity, but right now, for those of you who are in the early stages, this is not a category to look at because category is extremely overcrowded. But it's a good example, a good proxy for the types of opportunities you're looking for. Now, what are the highlights of your portfolio? I think the last set of conversations I'd like to have is if you could give us a few examples rapidly and tell us what caught your attention about those companies. Why did you choose to invest in those? Ideally, where you went in early stage.
Yeah, so and when you mean highlights, you mean exits or companies that we're excited about that are sitting in
Doesn't matter. Either way is fine. Either way is fine. Something that you think very highly of is the highlight.
Well, I mean, I'll pick 3 or 4 software as a service companies and they're all multi-$100-million $revenue companies. They're all growing north of 25%, and they're all valued at, by certain investors at over, $1 billion, let's just say. And we invested in all 3 companies. In 2 of the 3 companies, we were the first institutional investor in, and the third one, we were the second institutional investor in. And we invested in all of them before they had over $1 million of annual recurring revenue. So at early stages in all 3. So the first company is a company called Apptio. They've created a new category of business management called technology business management. And simply put, that is how do you manage the cost of IT in the enterprise? How do you treat IT as a business? How do you treat it as a service? Measure its cost, plan its cost, execute its cost. That didn't exist before Apptio got there, and they created a new category. They actually created a new business management practice, and through that created a $200 million plus business. They're a public company now, and they're worth $1.5 billion in the public markets, and they're traded on NASDAQ today.
And folks, those of you who are listening, the Apptio case study is on our blog, so you can go look it up.
And it was started by an Indian entrepreneur, Sunny Gupta, who's a multi-time entrepreneur, very successful. The second company is a company called Zora, just recently went public, and they're a billing company, and the CEO recognized the power of subscription businesses 10 years ago, and that subscription businesses were going to be the way many enterprises were going to monetize their customer relationships, whether they were business-to-consumer businesses or business-to-business businesses. So, for example, Caterpillar, that makes large tractors. They actually make a lot of their money, and most of their money, through the service component after the tractor is bought. GE Aircraft, which makes big, large engines, a huge portion of their business is the aftermarket service that the airlines contract with them, and those are all subscription businesses. And he recognized this, and he created a whole new, economy. He went beyond just creating a business management practice and said, look, the world is moving to a subscription economy. And in order to move to a subscription economy, you need to have the right billing systems for that and the right financial systems for that, and I'm going to build that. And Zora created that from the ground up. They're a multi-$100-million company, and they're right now trading on, I think, the New York Stock Exchange with a $3 billion market cap on them. And it was started by Keen Zhu and KB Rao, a Chinese immigrant and an Indian immigrant. And KB was an immigrant himself. Keen was brought over here by his parents, like myself. I'm an immigrant, but I didn't actually immigrate. My parents just put me on the plane. And then the last company is a company called Anaplan. Anaplan is really taking Excel and put it in the cloud and put it at scale so businesses can plan better and really model any type of business problem, whether that's how do I do my financial plan for the year? How do I do my sales and territory quota management for the year? How do I do my workforce planning for the year? You can build all of that with Anaplan. And they've been growing very well, and they were at the company we invested in when they had less than $1 million worth of subscription revenue, and now they have lots of customers, and you can go look up what they talk about themselves on their website. They are still a private company. And in all these 3 cases, you say what's common, passionate entrepreneurs who had a unique insight into a customer problem. And that's key. And in all three cases, they had various degrees of product market fit. In Apptio's case, when we invested, they had talked to 15 enterprises, and all these enterprises had wanted the solution. And we could see a clear reason why the CIO needed the solution. And it made sense to us. Even though they had no customers, we could see why a CEO would buy, because the CIO was getting pressure that IT costs were increasing, and they needed to justify that IT cost spend to the other lines of business, to the CFO, the CEO, the general managers of their business. And there was another class of CIOs that really wanted to transform IT from managing hardware to actually providing services that their customers, the employees, were going to use, and really enable their customers, other employees, to understand what the cost of those services were and help the business make better decisions. We could see the logic in that, and we had the logic validated. With Zuora, we could see the rise of subscription services through SaaS, through services like Netflix, but frankly, I don't think we saw it as getting as big as it is today. But we knew that GE Aircraft had a business around services. And they had, at the time we invested, 20 to 25 customers. And Anaplan was going after an age-old problem. I'd actually worked in a company that, Hyperion, which built a financial planning system. And when I was in India in the early 90s, I built a modeling system similar to Anaplan, obviously not as sophisticated, for a large pharmaceutical company, Glaxo. So I knew the benefits of being able to create multiple plans, have a platform that was sophisticated across different dimensionality. And the problem was that the technology wasn't available to truly deliver that flexibility at scale. And when we invested in Anaplan in 2010, we could see that the memory fabric of compute machines was big enough, and the technology was now available to actually deliver a very flexible planning solution. And the founders that were building it were building the same solution for the second or third time. They knew what they were doing. And they had an initial set of customers who loved the product. So in that case, we didn't need to validate the need as much as would it work. And we got early evidence that they had built a wildly successful product.
Very interesting. You know, audience, you just heard the investor perspective from Ravi about these three companies, Apptio, Zuora, and Anaplan. We have all three case studies on the Entrepreneur Journey series. You can hear the entrepreneur perspective there as well, and I would strongly encourage you to go check out those case studies just to get a feel for what their entrepreneur journeys have been like and how they have built these companies. Obviously, all three are unicorn companies and very successful companies. So, Ravi, that's great perspective on what you are looking for. And, you know, I will reemphasize for the audience what you just heard from Ravi about product market fit. You hear this from us all the time, that if you can get to successful product market fit, successful levels of repeatability, understanding that this is the logic of the business, and this is how you can repeat that logic, sell over and over again, and scale businesses at a fast pace. That is what investors are looking for. That is what Ravi is looking for. That is what Shasta is looking for. Is that a good summary of what you said, Ravi?
Yeah, absolutely. And it's a difficult journey finding a product market fit, and
very difficult.
And it's something that it can be incredibly rewarding and incredibly frustrating. So it's hard.
Yeah. So Ravi, thank you for sharing those perspectives. I know you have to run, but thank you for participating today, and we'll keep in touch. Hopefully, do some work together.
Thank you, Sumarna, for the opportunity and ability to share a little bit about Shasta and my thoughts. I really appreciate it.